empowering your financial journey. Hey there, future investors. Ever wondered how Warren Buffett, the Oracle of Omaha, amassed his staggering wealth? Well, get ready to dive into the secrets of one of the most successful investors in history. In this video, we're uncovering the golden nuggets of wisdom that propelled Warren Buffett to legendary status. Stay tuned for his top 5 tips for long-term investing that could potentially transform your financial journey. Welcome back, everyone. I'm thrilled to have you here as we embark on an exciting journey into the world of investing, guided by none other than the maestro himself, Warren Buffett. Now, for those of you who might not be familiar, Warren Buffett is a name synonymous with investing excellence. With a net worth north of $100 billion, he's not just successful, he's an investing icon. Known for his down-to-earth wisdom and unparalleled track record, Buffett's insights are like gold in the world of finance. Today, we're on a mission to distill Buffett's wealth of knowledge into 5 actionable tips for long-term investing. Whether you're just starting out or looking to refine your investment strategy, these tips are bound to be game changers. So, grab your notepads and let's dive into Warren Buffett's top 5 tips for long-term investing. Let's get started. Absolutely. Let's delve into tip number 1, invest in what you understand. Investing in what you understand is like having a compass in the world of finance. It's about putting your money into businesses or industries that you have a good grasp of, rather than blindly following trends or fads. Warren Buffett, the master of this principle, built his empire on this very foundation. He's often said, never invest in a business you cannot understand. This golden rule acts as a guiding star for both seasoned investors and those just dipping their toes into the world of finance. Consider Buffett's investment in Coca-Cola. He didn't just see a popular soft drink, he saw a brand that had become part of the fabric of American culture. Understanding the enduring love people have for the product, he recognized its potential for long-term growth. This is a prime example of investing in what you understand. It's about recognizing the intrinsic value of a company and having confidence in its future. Now, let's talk about why this principle is a game changer. When you invest in something you're familiar with, you're not just relying on market trends or analyst predictions. You have an intimate knowledge of how that business operates, what drives its success, and how it might navigate challenges. This knowledge acts as a shield against hasty decisions and impulsive moves. It minimizes the risk of making costly mistakes and sets you on a path of making informed, calculated choices. Furthermore, investing in what you understand empowers you to stay engaged and proactive. You're more likely to keep up with industry news, follow the company's performance, and anticipate shifts in the market. This level of involvement not only strengthens your confidence but also enhances your ability to make timely adjustments to your investment strategy. It's like being the captain of your own financial ship, navigating with confidence towards your long-term goals. So, remember, the next time you're considering an investment, ask yourself, do I truly understand this business? It might just be the key to your financial success. Absolutely. Let's dive into tip number 2, focus on intrinsic value. Alright, let's talk about something that's like a secret sauce in Warren Buffett's investment recipe, intrinsic value. Now, think of intrinsic value as the true worth of a company, beyond what its stock price might suggest. It's like looking at the core assets, earnings, and potential of a business. Buffett's keen focus on this concept has been a cornerstone of his investment philosophy. Buffett doesn't just glance at a stock chart and make decisions based on short-term trends. He's all about the long game. He meticulously evaluates a company's intrinsic value. This involves digging deep into financial reports, scrutinizing the management, and understanding the competitive landscape. This thorough analysis allows him to get a crystal clear picture of a company's true value. Now, here's why this is crucial. Imagine you're buying a house. You wouldn't just look at the paint job, right? You'd inspect the foundation, the wiring, and the overall condition. Similarly, focusing on intrinsic value prevents you from being swayed by temporary market fluctuations. It's like having a solid anchor in a stormy sea of stock prices. Buffett's track record is peppered with instances where he identified undervalued gems. take the case of American Express. Back in the 60s, it faced a major crisis, and its stock price plummeted. Many investors ran for the hills, but not Buffett. He saw the intrinsic value, the trust people had in the brand, and its enduring appeal. He invested heavily and, boy, did it pay off. This exemplifies the power of recognizing a company's true worth, even when the market is in turmoil. So, remember, next time you're eyeing a potential investment, don't just focus on the surface. Dive deep, uncover the intrinsic value, and you might just unearth a diamond in the rough. It's like seeing the potential in a startup before it hits the big leagues. Stay tuned for more insights from the Oracle of Omaha. Absolutely. Let's now move on to tip number 3, think long-term, ignore short-term market fluctuations. Alright, now we're getting into the nitty-gritty of Buffett's wisdom, thinking long-term. This isn't about quick wins or overnight success. It's about having a vision that stretches far beyond the horizon. Buffett is like the marathon runner of investing, not the sprinter. He understands that Rome wasn't built in a day, and neither are great investment portfolios. One of the things that makes Buffett stand out is his ability to tune out the noise of short-term market swings. While many get swept up in the frenzy of daily ups and downs, he remains unflinchingly focused on the fundamentals of a company. Picture this: imagine you're driving through a scenic route. You might hit a few bumps along the way, but that doesn't deter you from reaching your destination. Similarly, Buffett doesn't let short-term market fluctuations derail his investment strategy. He keeps his eyes firmly on the prize, the long-term growth potential of a business. Now, let's talk success stories. Buffett's long-term approach has been the cornerstone of his incredible track record. Take his investment in the Coca-Cola Company. When he first bought into it in the late 80s, he didn't expect an overnight jackpot. He saw the enduring love people have for the brand and envisioned the long-term potential. Over the years, this investment has paid off handsomely. It's like planting a sapling and watching it grow into a mighty oak. So, the takeaway here is this: when you're investing, think of it as planting seeds for a bountiful harvest in the future. Don't get bogged down by the daily market chatter. Trust in your research, have faith in the company's fundamentals, and let time be your ally. Buffett's success is a testament to the power of thinking long-term. Stay tuned for more nuggets of investing gold. Absolutely. Let's move on to tip number 4, maintain a margin of safety. Alright, folks, let's talk about a crucial concept in Warren Buffett's playbook, the margin of safety. Think of it as a safety net, a cushion that protects your investments when the unexpected happens. It's like wearing a seatbelt when you drive. You hope you won't need it, but it's there to keep you safe just in case. Now, why is this principle so fundamental to Buffett's strategy? Well, imagine you're building a bridge. You don't just design it to barely hold the weight, you build it to withstand far more than you anticipate. Similarly, a margin of safety in investing means buying a stock for less than you believe it's truly worth. This way, even if the market takes a temporary dip, you've got that extra buffer to weather the storm. Buffett's brilliance shines through in how he applies this principle. Let's take his investment in the insurance company, Geico, as an example. When he invested, he saw that the stock was trading at a discount to its intrinsic value. He recognized the strength of the company and the potential for it to bounce back even stronger. By buying at a price below his calculated intrinsic value, he built in a substantial margin of safety. Now, why should you care about having a margin of safety in your investments? Well, it's like having a financial safety net. It gives you peace of mind knowing that even if the market experiences turbulence, you're not on shaky ground. It allows you to make decisions with confidence, knowing that you've got that extra layer of protection. So, next time you're considering an investment, remember the importance of leaving some room for error. It's like having an extra parachute when you're skydiving. Stay tuned for more investing wisdom from the Oracle himself. Absolutely. Let's wrap it up with tip number 5, be patient and disciplined. Now, let's talk about a quality that might not be as flashy as quick trades or bold moves, but it's just as, if not more, crucial: patience. In the fast-paced world of investing, it's easy to get caught up in the rush, but Warren Buffett teaches us that patience is the secret sauce to long-term success. It's like tending to a garden. You plant the seeds, water them, and then patiently wait for them to grow. You don't dig them up every day to check if they're sprouting. Buffett's journey is a testament to the power of patience. Take his investment in the Coca-Cola Company. He didn't expect instant results. He understood that greatness takes time to unfold. Over the years, his patience paid off in spades, as Coca-Cola became a cornerstone of his portfolio. So, how can you cultivate this invaluable trait in your own investment journey? It's like training for a marathon. You start with small steps, stay consistent, and gradually build your endurance. Set realistic expectations, have a long-term vision, and avoid being swayed by short-term noise. Remember, Rome wasn't built in a day, and neither is a robust investment portfolio. And here's a pro tip: keep an eye on the bigger picture. Celebrate your wins, but don't be discouraged by temporary setbacks. Stay disciplined in your approach, and over time, you'll reap the rewards of your patience. It's like compounding interest: the longer you stick with it, the greater the returns. So, remember, in the world of investing, patience isn't just a virtue, it's a superpower. Stay patient, stay disciplined, and watch your investments flourish over time. Thanks for tuning in, and remember to hit that like and subscribe button for more valuable insights. Happy investing! And there you have it, folks. We've just unwrapped 5 invaluable tips for long-term investing, straight from the playbook of the legendary Warren Buffett. Remember, invest in what you understand, focus on intrinsic value, think long-term, maintain a margin of safety, and above all, be patient and disciplined. These principles are the bedrock of Buffett's success, and they can be yours too. I encourage each and every one of you to apply these tips in your own investment journey. Start small, stay consistent, and watch your investments grow over time. Now, I'd love to hear from you. What are your thoughts on these principles? Do you have any questions or experiences to share? Let's spark a conversation down in the comments. And before you go, a big thank you for tuning in. If you found this video helpful, please don't forget to hit that like button, subscribe for more insightful content, and share this video with fellow aspiring investors. Together, let's build a community of smart, savvy investors. Until next time, happy